Hey everyone, Paul here. I had a request from somebody to walk through options and just kind of walk through how they work. And they specifically said that, that they've tried to understand them before and kind of just, it never really clicked with them. So that's really going to be my goal, is to walk through options to really make sure that you understand how they work. And I'm going to do that by first kind of showing you in Excel how we can kind of walk through and think about options. And then I'm going to move over to Robinhood, where we can actually see how they're laid out for real stocks. Okay, so when we start thinking about options, I mean, just the basics of them, right? An option is giving you the right to purchase a stock at a certain price, but not the obligation to do so. Okay, so that's very important to keep in mind. Another thing with options is that you're not risking any more than the actual options contract itself. I think, that's good to know if you're just starting out with options. And what that means is, let's say that you spend $100 total betting that you think a stock is going to go lower. Well, what happens if that stock rockets 20 times higher, does something crazy, okay, pulls a Tesla? Well, in that particular case with an options contract, the most you can lose is that $100. Okay, that's a little background on it, but now let's get into what we're looking at on the screen here. Okay, so we are going to walk through a hypothetical option. Now, we're going to assume that the option expiration date for this contract in our made-up example is going to be January 29th, 2021. Now, options typically expire on a Friday. Okay, and what that means is that you have an option based on the price that you're agreeing to pay for that stock. You have the option to purchase that up to and including the expiration date, but after that date, you're no longer able to do so. Another thing to keep in mind with options is that each options contract gives you the right to purchase 100 shares. Okay, so if you buy one contract, you are controlling 100 shares. Now let's just put in, something small just to kind of show you this, right? So if you have something like, let's say that, let's make it up here. So let's just say that, the current share price is $1, and that the strike price, and the strike price being, this is the price that you're agreeing that you could buy it in the future. So if the stock is currently at $1 and somebody says to you, hey, I'll give you the option to purchase that for $2 anytime up to and including January 29th, they would be saying that you could purchase it at the $2. And then you might be saying, okay, well, what do I have to give you for that option to buy it at $2 in the future? Okay. Well, you have to give them, in this made-up example, you'd have to give them 50 cents, okay? Now, that is the price of the options contract per share, but we had already mentioned that each contract has 100 shares by default, okay? So, if it's going to be 50 cents per share, and we know that there's 100, okay, then the total options contract cost is going to be down here for the bottom, laid this out here, is going to be $50. Okay. So that's how much the actual contract costs. It's always going to be that per share amount, and then it's going to be multiplied by that 100. That's going to be your total contract cost. Okay. Now, and I think Robinhood actually does a pretty good example of laying out your break-even percent. And in fact, they do a better job, in my opinion, of laying this out. It's more user-friendly for the options layout on Robinhood than it is on Fidelity or Schwab and some of the other major brokerages. But I think when it comes to the actual execution, I prefer the major brokerages. But when it comes to actually kind of looking through what the options contracts what the details are, I like to kind of look through them on Robinhood. And when I, make my determination if I was going to buy an options contract, I would then go over to my Schwab account and execute it there. So there's a few different things that I actually do use Robinhood for. I use Robinhood to be able to manage my my stock watch list, for example. So I keep track of that in Robinhood. I like how Robinhood kind of groups stocks together based on, like, you can search for like household goods and there's a group of stocks together. So I kind of use Robinhood as more of like a tool to like screen stocks, to be able to manage my watch list, to be able to check out options contracts. But when it comes to the actual execution, I decide to go with Schwab. Okay, so continuing to walk through this example, and again, I plugged in some random examples. Let's just continue to look at this one here. So if, and this is absolutely made up, but in this particular example, if the stock is currently at $1 and your strike price, so the price that you have the option to buy it at, if you were to buy this contract, is $2, okay, then you need to ask yourself, okay, so you're buying it for $2 with the strike price, but you're paying 50 cents for the privilege to have that option to do so, okay? So what that means is it's always going to be that your break even is going to be the options contract per share that you're paying, that premium, plus the strike price, which is that option that you have to buy it at. So in this particular case, it's currently trading at $1. This stock, in order for the option to be exercised where you're making money, would need to be over $2.50. So, if you were looking at this and you were saying to yourself, hey, I could buy this stock at $5, or I believe this stock is going to go to $5, maybe that options contract makes sense to you. Keeping in mind that, you'd be getting that for $50, and if it expires worthless, it expires worthless. But, that's an example of kind of how that works. And this break-even percent that we have here, so this is showing that the stock would actually need to appreciate by 150% between now and January 29th, 2021 in order for you to break even. Okay, so that's just breaking even, going by 150%. Made up example, again, keep that in mind, but if you were to see an options contract laid out in this way, that's what that would be. Now, the break-even percent, as I was saying, is actually available in Robinhood. That isn't as readily accessible in some of the other big brokerages, so I think that is a nice thing to be able to just see. And again, I will go over to Robinhood and we'll get into some more detail on that. Let's now kind of go through just another simple example. So let's just say that you have a stock that is trading at $100 currently, okay? And let's say that you want to buy an option to buy this at $110, okay? Well, you're going to be paying more than 50 cents for that, but, let's just say that it's going to be $5. Let's call it that, okay? So now you're going to say that it's currently at 100. You're getting the option to buy it at 110, but because you're paying $5 per share for that right to get it at 110, the stock would actually need to go up by 15% before you would break even. So if the stock was actually trading anything above $115 that we see here, anything above $115, you would be able to exercise that option while making money. But another thing to keep in mind with options is that most options contracts are not actually, you don't make your money by exercising them and actually going through the process of saying, I want to buy the 100 shares for my one options contract. What happens in a lot of cases is people can use options to, put themselves in a situation where they can get a big return, with really big moves. And what do we mean by that? Well, let's take a look. If you were looking at a company that is currently trading at, let's say, $5, okay? Let's say that you get an option, and let's just say that you happen to think that this stock is just going to explode. Maybe it's a biotech, maybe whatever it is. So let's just say you think that there's going to be some good news coming along that's going to make this stock absolutely spike. Well, if we were going to say that we wanted the option to buy this at $20, and we're saying that right now we're in December 20th, so you had like 5 weeks for this to come true, where you'd get the option to get it at 20, but it's currently at 5. Well, that options contract is probably going to be priced somewhere, pretty cheap. So maybe it's going to be priced at 20 cents. Let's just make it up, okay? So what happens is that let's say that this actually never gets to the point where it gets over our $20.20, which would be required for this to break even if you were going to exercise the options contract. But for every dollar that it's getting closer to the strike price, this options contract is increasing in value. Because think about it. If you have right? I mean, let's just say that like literally 5 seconds goes by and you have the option, to buy a stock for $20 and it's currently trading at $5. Well, now all of a sudden imagine that it's trading at $6. Well, I mean, it's that much closer to that $20, so that option is more valuable. You might say it's still cheap. Like maybe it goes from like 20 cents to 40 cents in that particular case. But if you think about it, you just doubled your money because up until you exercise your contract price, you can sell that contract to somebody else. So if you were able to buy this at 20 cents, okay, you would say that your total contract cost would be 5. But you can also keep in mind that, you could scale that up by saying that you wanted to buy more than one options contract. And I'm going to add that to it right now because really if it's down over here. So, like you could say that, oh, okay, it's only $20. But I mean, if you were going to buy, 50 options contracts, all of a sudden you could get yourself up to $1,000 and make it a little bit more meaningful. But, right now, like let's just say it's that $20 that we're talking about. If this did double, then that $20 would become $40. Or your $1,000 would have become $2,000, or and so on. So, in some cases, you might say that, well, what if the share price goes from $5 when you're buying this option contract at 20 cents? Let's say that it actually goes up to, let's say it goes to $18 a share. Okay. Well, then all of a sudden your options contract, it actually, in all likelihood, this might jump to like, let's say $3. And if that jumps to $3, well, then all of a sudden your $20 turned into $300, which is a huge percent return. Okay, so those are the kind of two different ways to think about the options contract. So one is thinking about if you're actually going to exercise the option. That is to say that you actually want to buy the stock at the strike price, which is the option that you have the ability to buy that at. Okay, you want to buy that. You'd have to pay, or consider the premium of the option per share and the strike price, add those together and kind of take a look at and say, is the stock currently trading at or above that? And if it's above that, you're making money by executing that deal. But the other option is just to sell the options contract. And again, kind of just some things that you need to learn when you're looking at this. I think a lot of times when you're trading stock, you can get pretty used to, high liquidity. You get used to the fact that if you want to sell Apple stock, you don't have to kind of wait around. You don't have to worry if people are going to buy that. There's enough buyers out there, enough liquidity where you can basically do that whenever you want to. That's not the case with options contracts on even some mid-sized companies. There might be, only a handful of options contracts trading on any given day for some companies. And what that means to you is you might get yourself in a spot where, you have 50 options contracts and you want to unload them, and maybe you can't sell them all right away. And so it gets really important to be able to keep an eye on what your limit prices are and things of that nature. But with low liquidity, you can get some interesting, weird jumps in prices. And, it might be showing up in your app as saying that you're making 150%, but you go to sell it and maybe you're actually losing. So you can get some pretty wild things with low liquidity. But with all this said, let's jump over to Robinhood, and we're going to go ahead and take a look at some things over there. And then I want to kind of also tie it back over here to make sure that it makes sense with what we're seeing in Robinhood, with what it makes sense in our model over here. So, okay, so we go over to Robinhood here, and what I'm going to do is I'm going to take a look at Target stock. No particular reason, just wanted to pick a random one here. But the way this is laid out is we have our strike price. So this is saying, let's just look at this one row here as an example. So we are looking at options expiring January 29th, which is, again, going to correlate with that example that we were walking through in Excel. In this particular case, our strike price, again, is going to be on the left-hand side. And that strike price is just saying this is the price that you can buy the stock at per share. So if our options price per share was 0, and you were able to just say, hey, I have the option to buy this at 170, it would just be you buying it at 170. But we know that there is a cost for that option per share, so you need to factor that in, okay? And that cost of the option per share is all the way over here to the right. So this is saying if you wanted to buy this, and if you were able to get it at this price, that you'd be paying $6.75 for that options contract. Again, keeping in mind that when you actually go to buy this on Robinhood, so we're going to go ahead and we hit the plus here, okay, we hit continue. If we put in our one contract, we see that it actually is now saying that it's going to be a max cost of $675. So it's not charging us $6.75 because this is per share, and contracts have 100 shares per shares each, as we've already talked about. So again, your total cost is always going to be your per share amount multiplied by 100, and that's only going to be different if you increase the number of contracts that you would like to purchase. Okay, so let's just plug these numbers in and go back over to Excel here. So we have the 129, that's true, 100 shares per contract, that's always going to be true. And we can say that the current share price is 170.25. So we're going to plug that in. 170.25. The strike price was 170. That's the price that we would have the option to purchase it at. But our the option cost per share is $6.75. Okay. And then this is saying that the option per share, or the cost per share with the option included into it, is $176.75. So if you wanted to buy this in the future, that's what you'd be paying. And then it shows you the break-even percent. So in this particular example, the stock would actually need to go up by 3.82%, which if we look back over here is exactly what Robinhood is showing. So that would need to be increasing by that 3.82% in order for you to break even, if you were going to hold on to this with the intention of actually executing this. And then just down here, we can see that 675 of your total options contract cost, which is exactly what Robinhood is showing you over here. Okay. Now, what we can also see is how much this options contract has changed today. So this options contract actually changed. It fell by 4.66%. This one fell by 15%. You look at it, and its target was actually down by 0.58%. So, the value of these options to buy the stock in the future are declining because, the stock was down slightly, but even this kind of shows you how sensitive the options contract is relative to the actual share price. Because again, this changed by 0.58%, and you're seeing, this contract changed, it went down by close to 10%. This one by close to 5%, over 15%. So there's a lot more sensitivity in the options contracts than what the underlying share price has. And so that's something that can work for you, if a stock is going up aggressively and you own a call option, your options contract is likely going to increase by a lot more in value than what the share price is. But again, that's a double-edged sword, and just keep in mind that that can go against you, just like it can go for you. And always keeping in mind that the most you can lose is the actual total cost of your options contracts, and you can't lose any more than that, okay? Let's see. As you actually move closer to the expiration date, other things equal, your options contract is going to become less valuable. So we can also think about that, just because, look, if there's no change in the share price and you're buying this hoping that the share is going to go higher, and you now, let's say another day goes by, that's one less day for you to be able to hit your target, or one less day for the stock to go high enough to reach your break-even percent. So because of that, every day you get closer to the expiration, if your price isn't going to go higher, your options contract is going to become less desirable. There's also going to be, again, more, sensitivity for the price changes that are happening for the contracts as you get further and further away from the actual price. So we look at this again. So this is at this 170. You'd have the option to buy it at 170, and it's currently at 170.25. So even with our premium, we'd be saying that our break even is 176.75. And the stock price would actually need to increase by 3.82% for us to break even. But if we scroll up, we actually see that there's some options that we can buy. How high does this go? All the way up to $225. Now, this is kind of very similar. Remember, if I told you earlier that some of these options contracts, you can buy them, for pretty cheap amounts, right? So this options contract actually was up today, oddly enough, but you could have bought this for 26 cents, and you were able to buy this for so cheap because the odds that, you're actually going to be able to get target up to 225 by that January 29th expiration, are pretty low. But again, this is also a particular case where if you believe that Target, like whatever reason, like let's say you think they're going to just have breakaway holiday results, let's say you think Walmart's going to go out a bit, whatever thesis you have, if you think Target is actually going to rally up over 225, being able to buy options contracts at 26 cents per share would be very valuable to you, because again, that's going to go much, much higher than 26 cents, per share for that option premium. So that's on the buy side. You would be using a call for that if you wanted to buy into this. If you thought Target was going to go lower, you would just click over here and click on put. Now, the puts for Target are actually showing they're in the green. And they're in the green because the stock, again, was down slightly, only down that 0.58% that we talked about. But just with the stock down that much, these options contracts are actually higher by the amounts that you're seeing here. So this one here, if you were trying to sell or basically short the stock at 170, you'd be paying a 605 premium. The stock would need to fall by 3.7% before this would break even. Okay, but the actual price of this options contract went up by 8.04% today. Okay, so that's how options contracts work. I tried my best to kind of make that as simple as possible. I think that, unfortunately, I think options, there's just a lot of complexity to them. I certainly would be happy to follow up with any questions on this. I want to make this as simple as to understand as possible. So let me know if this was helpful to you, if you are trading options, if you, just love to know your thoughts. So let me know in the comments below, and I will see you next video.